What you are about to see is evidence of the largest transfer of wealth in the history of the American housing market. But this time, it is not the wealth of the American middle class that is being wiped out. It is the wealth of the so-called smart money. The mainstream financial news is staying completely silent on this. They are telling you that home prices are stable. They're telling you that a soft landing has been achieved. But while everyone has been focused on mortgage rates and individual homeowners, a massive $2 trillion bomb has been ticking behind the scenes. Wall Street's unprecedented housing bet, a gamble that saw hedge funds, private equity firms, and even your own pension funds buy hundreds of thousands of homes at the absolute peak of the market, is now collapsing. And we are not just speculating here. We have the data to prove it. According to a bombshell new report from Zillow, we are witnessing a level of value destruction that we have not seen since the dark days of 2012. The data shows that 53% of homes in the United States are now losing value year over year. Let that number sink in. More than half of the entire housing stock in this country is currently bleeding equity. But that headline number, as shocking as it is, actually hides the real story. When you peel back the layers and look at where these losses are concentrated, a terrifying pattern emerges. The losses are not happening in the stable, boring markets where families live for decades. They are happening in the exact neighborhoods that Wall Street targeted during their buying frenzy of 2021 and 2022. The institutional investors who bought millions of homes when prices were at their all-time highs are now sitting on what industry insiders are quietly calling the mother of all bad bets. In this video, we are going to break down exactly what is happening. We are going to show you the math behind this $2 trillion collapse. We will reveal the specific cities where institutional investors are already secretly dumping their properties. And most importantly, we are going to explain why this institutional failure is going to create the buying opportunity of a lifetime for you if you know exactly when to strike. To understand why this collapse is happening now, you have to understand the sheer scale of the mania that took place just 3 years ago. During the pandemic, we saw the birth of a new kind of housing market. It was no longer about families buying homes to live in. It was about yield. It was about asset accumulation. Institutional investors, flush with cheap cash from the Federal Reserve, went on a shopping spree that defies logic. Companies like Invitation Homes, American Homes 4 Rent, and massive private equity giants like Blackstone poured billions of dollars into the single-family housing market. They did not just buy a few houses, they bought entire zip codes. In 2021 alone, investors bought nearly 1 in every 4 homes sold in America. In some markets like Atlanta, Phoenix, and Charlotte, that number was closer to 1 in 3. They were paying 20%, 30%, sometimes 50% over the asking price. They waived inspections. They paid cash. They bullied regular American families out of the market with brute financial force. But here is the critical mistake they made. They bought for appreciation. They bought under the assumption that home prices would only go up forever. They modeled their portfolios on the belief that 10% or 15% annual growth was the new normal. They were wrong. Now, the music has stopped, and these massive funds are left holding the bag. According to CoreLogic data, during the peak buying frenzy of early 2022, institutional investors paid an average of $420,000 per home in their target markets. Today, based on current Zillow estimates, many of those same homes in markets like Austin and Tampa are worth significantly less. We are seeing average valuations in these specific institutional hotspots drop to $360,000 or lower. Do the math. That is a $60,000 loss per property. Now, multiply that by the 300,000 plus homes that were purchased during the peak mania. You are looking at tens of billions of dollars in equity that has simply evaporated. Gone. And that is before we even talk about the leverage. This is where the situation goes from bad investment to systemic risk. You see, Wall Street does not buy houses with their own cash. They buy houses with borrowed money. They use what is called leverage. When a regular person buys a house, they get a 30-year fixed mortgage. If the value of the house drops, it is painful, but as long as they can make the monthly payment, the bank does not come knocking. Institutional investors do not have that luxury. They use short-term floating rate debt. They use warehouse lines of credit. And most dangerously, they use asset-backed securities. Essentially, they bundle thousands of rental homes together and sell bonds against them. It is the exact same playbook that caused the 2008 financial crisis, just with rental income instead of subprime mortgages. But here's the catch with these financial instruments. They have covenants. These are strict rules that say if the value of the underlying homes drops below a certain level, the borrower, in this case, the hedge fund or the REIT, must put up more cash immediately. This is called a margin call. And right now, margin calls are starting to trigger across the Sun Belt. When you are leveraged 70% or 80% on a portfolio of homes, and the value of those homes drops by 15%, your equity is not just damaged, it is wiped out. We are already seeing the first signs of this distress. Banks that lent billions to these funds are quietly tightening their leashes. Wells Fargo and Bank of America have both signaled a retreat from the institutional lending space. They know what is coming. They are demanding more collateral. And where are these funds going to get the cash to pay these margin calls? They only have one option. They have to sell the houses. Now, you might be thinking, who cares if a few hedge funds lose billions? They are rich. They can handle it. And if it were just private equity billionaires losing money, we would all be celebrating. But unfortunately, the web of exposure goes much deeper than that. The money that fueled this housing bubble did not just come from wealthy individuals. It came from you. It came from the retirement accounts of teachers, firefighters, police officers, and public servants across America. Major pension funds, desperate for returns in a low interest rate world, allocated massive amounts of capital to real estate during the pandemic. Let's look at CalPERS, the California Public Employees Retirement System. It is the largest public pension fund in the United States. During the peak of the market, CalPERS allocated billions specifically to real estate strategies that targeted single-family homes. The Teacher Retirement System of Texas did the same. They poured nearly $2 billion into funds that were actively buying up neighborhoods in their own state. These pension funds were sold a lie. They were told that single-family rentals were a safe asset class. They were told it was a hedge against inflation. Instead, they bought the top. Now, the latest disclosures from these pension funds are showing the cracks. Real estate returns for major pension funds have turned negative for the first time since the great financial crisis. The Texas Teachers Fund recently reported a negative return on their real estate portfolio. This puts these funds in a terrible position. They have obligations to pay retirees every single month. They need liquidity. If their real estate bets are losing money, they have to sell other assets. Or worse, they have to force the liquidation of the real estate portfolios to stop the bleeding. This is the pressure cooker that is building right now. You have leveraged hedge funds facing margin calls on one side, and you have massive pension funds demanding their money back on the other. And stuck in the middle is the housing market. We need to get specific about geography because real estate is local. If you live in a suburb of Boston or a quiet town in Ohio, you might not see this happening yet. The institutional collapse is highly concentrated in the boomtowns of the pandemic. Let's look at the data from Zillow for the institutional darlings: Florida, Texas, Arizona, and Georgia. These 4 states accounted for nearly 40% of all institutional purchases in 2021. And today, they are the epicenter of the value collapse. Take Austin, Texas. This was the poster child for the tech boom. Wall Street believed Austin would be the next San Francisco. They bought thousands of homes there, driving the average price up to insanity levels. Today, Austin is leading the nation in price declines. Institutional investors who bought homes for $500,000 are now seeing comparable sales in the $380,000 range. That is a bloodbath. We're talking about nearly $600 million in equity destruction in just one metro area. Then look at Florida. The Sunshine State is facing a perfect storm. Not only are home values dropping, with condo values in some areas down nearly 10%, but insurance costs are skyrocketing. Institutional investors hate uncertainty, and Florida's insurance market is the definition of uncertainty. American Homes, For Rent, one of the giant publicly traded landlords, recently admitted in their earnings call that they are facing material headwinds in Florida. That is corporate speak, for we are losing money hand over fist. In Tampa, in Orlando, in Jacksonville, markets where institutions own 10% to 15% of the rental stock, we are seeing inventory pile up. And this brings us to the most dangerous part of this story, the liquidity trap. Institutional investors are not like you and me. When a family sells a house, they usually buy another one. It is a wash. The inventory stays balanced. But when an investor sells, they are not buying another house. They are exiting the market entirely. They are taking supply out of the rental pool and dumping it onto the sales market. Right now, we are seeing a strange phenomenon. In the markets dominated by investors, inventory is exploding. Texas currently has over 134,000 homes for sale. That is significantly higher than the long-term average. Florida's inventory is piling up at the fastest rate in the country. This is what economists call a liquidity event. The institutions want to get out. They need to get out. But they know that if they dump all their homes at once, they will crash the market instantly and destroy their own asset values. So they are trying to do it quietly. They are selling homes off market. They are selling to smaller investors. They are slowly listing properties on the MLS, hoping no one notices that Invitation Homes is the seller. But the data does not lie. We are seeing a surge in listings in the exact zip codes where these funds own the most property. And here's the problem. There are no buyers. Mortgage rates are still hovering near 7%. The average American family cannot afford these homes at the prices the institutions want to sell them for. This creates a standoff. The institutions are holding out for 2022 prices, but the buyers can only afford 2025 reality. Something has to give. And when you have debt payments due and investors demanding withdrawals, it is usually the seller who blinks first. Now, you will hear a very different story if you listen to the National Association of Realtors. They are out there right now forecasting a rebound. They are predicting a return to growth in 2026. They are telling you to buy now before prices go back up. You have to remember who these people are. The NAR exists to sell houses. They do not get paid if you don't buy. They have a vested interest in maintaining optimism, regardless of what the data actually shows. Do you remember what they said in 2007? They said subprime was contained. They said housing never goes down. They are using the same playbook today. They are ignoring the $2 trillion institutional overhang because it doesn't fit their narrative. They will tell you that inventory is still historically low. And on a national level, that is technically true. But it is a misleading statistic. Inventory is low in the Northeast and the Midwest, where institutions didn't buy. But in the Sun Belt, in the markets where everyone moved during the pandemic, inventory is back to 2019 levels and rising fast. The NAR is averaging the data to hide the crash, but you cannot average your way out of a margin call. So how does this end? What happens over the next 12 to 24 months? We are looking at a slow-motion liquidation that will likely drag on through 2026. Unlike 2008, where everything crashed at once because of bad mortgages, this crash is happening sector by sector, city by city. First, we are going to see the portfolio optimization. This is what is happening right now. The big funds are selling their worst-performing assets, the homes that need repairs, the homes in bad school districts, the homes with high taxes. Next, as prices continue to drift lower, we will see the credit contraction. This is when the banks cut off the credit lines. This forces the medium-sized funds, the ones who own 500 to 1,000 homes, into bankruptcy. When these guys liquidate, they don't do it slowly. They dump everything. Finally, we will see the capitulation. This is when the big players like Blackstone and Invitation Homes decide that the single-family rental trade is over. They will shift their capital to something else, maybe AI data centers, maybe logistics. But they will start unloading their massive portfolios in earnest. This is going to put downward pressure on home prices in the Sun Belt for years. I know this sounds grim, but if you are a prospective homebuyer, this is actually the best news you could possibly hear. For the last 4 years, you have been competing against a $2 trillion monster that didn't care about the price. You were bidding against hedge funds that had unlimited cash. You couldn't win. Now, the monster is wounded. The monster is retreating. As these institutions pull back, they are leaving a vacuum. And that vacuum is going to be filled by individual homeowners, people like you. But you have to be patient. You cannot catch a falling knife. According to our analysis of the inventory trends and the institutional selling patterns, the market has not hit bottom yet. The smart money is still trying to get out at the top. They haven't fully capitulated. The real opportunity is going to come in late 2025 and early 2026. That is when the inventory from these liquidations will fully hit the market. That is when the banks will force the sales. You will start seeing homes in your target neighborhoods sitting on the market for 60, 90, 120 days. You will see price cut after price cut. You will see listings that say motivated seller or asset manager direct. That is your signal. When you buy from a distressed institutional seller, you have leverage. They don't have emotional attachment to the kitchen cabinets. They don't care about the memories in the backyard. They just want the asset off their books. You can negotiate. You can demand repairs. You can offer significantly below asking price. This is a dynamic we haven't seen in over a decade. The era of Wall Street domination in the housing market is coming to an end. The $2 trillion bet has failed. The Zillow data confirms that the slide has begun. They thought they could financialize the American dream. They thought they could turn every neighborhood into a stock ticker. But they forgot that housing is ultimately about people. It's about affordability. And when you push prices beyond what people can pay, the market eventually breaks. It is breaking right now. Do not let the media gaslight you into buying their bags. Watch the data, watch the inventory, and get your finances ready. Because when this unwinding accelerates, the opportunity to reclaim the American housing market is going to be historic. Are you positioned to take advantage of Wall Street's mistake? Or are you going to be the liquidity they need to exit? If you found this breakdown valuable, make sure you hit that subscribe button. We are tracking this institutional sell-off every single week, and you are not going to want to miss the next update. Thanks for watching.